All right, good peoples. It's Bruce here with Targeted Wealth Creation. I've been promising this and I had a lot of requests for it. So let's jump in here. So a natural concern when you're buying something, and in particularly when you see something that maybe you think, well, that sounds fishy. How can they pay me 30% to own Microsoft? Or how can I own Amazon and get a 40% annual yield? It just seems too good to be true. Well, let's talk about that. So how's that accomplished? Just a 30-second. If you watch my videos, I talk about they use options. They don't own the underlying stock, which is all true. So it's a fairly sophisticated option strategy to mimic going long and owning the stock. Some of these stocks are very volatile. Therefore, they have what's known in the industry as a high IV. IV stands for implied volatility. Anything that's volatile, you've had a friend, if you say the slightest thing, man, they go off, right? We've all had those. So that person, you may say, boy, they're volatile, right? Their trigger is short. So that's the same thing in the options world. They set their pricing because if you look over 6 months and you see a $8 stock and it never goes more than 7 or to 8.5, right? And it's 8, you're like, that's boring, right? That's going to have a very low IV. But if you take an $8 stock and it's been $22 and it's been $2 and that all happened in 4 or 5, 6 months, then it's going to have a high IV. So therefore, when you buy options, sell options, calls, puts, the premium or that time decay portion is going to be very expensive. So first off, Yieldmax uses an option strategy to mimic being long the stock, and then they sell, they call them covered calls, but since they don't own the underlying stock, they're not covered. They're really just selling call options 5 to 15% out of the money on a weekly basis, hoping that the stock doesn't run past their call limit, and they keep the premium they sold the call for. They have the margin to do that because they're keeping 90% of these funds in treasuries and money market. All they're doing is buying and selling calls and puts, some to mimic long the stock, some to just make weekly income. So that's the strategy. So is it risky? I would say it's exactly the same risk as owning the underlying stock. If you go out and you buy Microsoft and it goes down 50%, well, if you buy Microsoft here, MSFO, and you get a 30% yield, if Microsoft goes down 50%, you're probably going to go down close to 50%. Now, you would have been paid a yield along the way, but let's say the yield's 30%. Well, but you lost 50% in your MSFO, your Yieldmax fund. So that's not a good investment, right? I collected 30% in dividend yield and I lost 50% in the underlying price. So I had a net 20% loss. So it's important that you pick securities or stocks that you're bullish on. So that brings us to the position of some of the crypto, Misty, Coney, the high-flying NVIDIA. You know, I can get an 80, 90%, 100% plus yield on some of these stocks. Well, isn't that risky? Well, it's risky in that who knows how long that yield will remain that high. And yes, could that stock correct 30%? Absolutely. So how do we hedge, okay, a Yieldmax ETF? It's not that much different than hedging any other security, but I'm going to go in to there's some peculiarities to it. So let's start with a definition. What is hedging? Well, hedging is a way to protect. Think about insurance. Okay, hedging is a protection of a loss, right? It's protecting a loss, it's insurance. So if you own a home, pretty much all homes these days have high values. I mean, it's relative to location, but I don't care where you are anymore in the world. Housing has gone up and gone up a lot. Okay. So what do mortgage lenders tell you if you go out and acquire a mortgage? What's the first thing that they want to know besides your down payment? And they require you to have insurance. Why do they want you to have insurance? Well, what if you buy that new house and you put 20% down and a fire comes in and burns it to the ground and you say, well, I'm out of here. I'm not making any more payments, right? Well, they got to rebuild that house, and replacement cost might be equal to what you paid for it. So they want fire, flood, other natural disaster insurance, right? So people go out and acquire insurance. Whether you have a mortgage or not, what if you make a typo like I did? Sorry about that. I saw it, couldn't resist. Okay, whether you have a mortgage or not, it seems foolish if you've got $500,000 or $1 million, or you're wealthy and you've got a multi-million-dollar home and you paid cash for it. So you say, well, I'm not going to waste my money on an insurance premium. What happens when a natural disaster comes along? Is it worth the risk? Probably not, right? So the same thing applies when you start to put a fair amount of your capital in any asset that could be a declining asset, potentially. So let's get specific to Yieldmax, since most of my subscribers have asked for this information. So in this first video, I'm going to go through an attempt to show you how to hedge Coney. Coney is one of the most popular Yieldmax funds. I'd say Misty and NVIDIA are right there with it. But I'll probably follow up with, Misty, NVIDIA, AMZ, Yieldmax, because Yieldmax is this already somewhat safer in the sense that it's got some 20 plus Yieldmax single stock funds in it, and it collects the dividends on all of them to pay you. So a market crash certainly would impact Yieldmax, but if somebody at Amazon committed a crime and it was the CFO and he lied about future earnings and there was a big scandal and he got fired, maybe the stock drops 20% on the news. Well, that's probably, if the market drops 20%, everything goes down 20%, not everything, but the majority. So you always want to hedge what you own. And if you have, so people are chasing yield. It's human nature. I can make 100. Look at Coney, for example. Let me run this by you again. So Coney has 9 payments or 10 payments. I believe it's 10, and I'll show you on one of the pages. So it came out at $20. It's trading at almost $22 now, I think. So after 9 payments or 10 payments, again, I apologize, it's collected $16.95 if you've owned it, and you paid $20 for it on the open, inception. So in 2 more months, and I believe it's 10 payments in, you will have collected you will have collected 12 payments, and you should be at like $20 return. So that's like 100% yield. Oh yeah, but what did the underlying do? You probably, it had a reverse split. No, right now the underlying is at 10%. Not massive gain, right? Better than some, but you got 100% yield. So add your 100% yield at the end of the year and then add your 10%. Now you have 110% total return. Okay? So it's possible it happens, but yeah, can you find one that didn't? Well, that's like stock picking. Show me a stock, that people invest in. I'll show you a bunch of winners and I'll show you a bunch of losers. Okay? So, and also it's not how much you have invested in Coney, it's how much risk you take on, therefore, that can determine the hedging. If I have $100,000 investable, and I'm foolish enough to put it all in just Coney and not even spread it to other funds, shame on me, but boy, I better really hedge that position, right? Because maybe 100 grand's all I have to invest. if that thing goes down 70% and becomes worth 30,000 and my yield, I still could collect yield, but maybe I'm so frustrated I just want out of it, which happens to people when the underlying NAV goes down a lot. So did you just take, say, and I use another example, half your investable capital and put it in Coney? Same thing. So let's go over ways to hedge this position. Okay, this can be a fairly technical, it can be a fairly exhaustive list, but I'm going to try to teach you some of the more easier methods. So let's jump in. So on Coney, and here's my example. I used this one, right? It's not mine personally. I actually have more shares, although last month for the first time I took a bunch of my Coney and moved it over to Misty because I could see in my daily reporting that for the month of June the payout was going to be much lower in Coney than it was going to be Misty, and it was enough where it offset the price difference of the two funds. Only because I've been doing this a while and I get very familiar. It's like if you trade a stock every day, you know the rhythm of the stock, you know the chart, you know what the tendencies and stuff. So I learn because I'm immersed in Yieldmax. All right, so here's the summary. I paid it, and I'm saying it's not me. Okay, so this person bought 5,000 shares. They bought them on 12/28/23. Okay, and that's a price that you could have paid. So they spent $116,100. Okay, so here's the payouts. You can go look these up on the Yieldmax site. This is what they paid for every month that person buying on 12/8, because they bought a couple of days after the December payment, so they wouldn't have been eligible. If they'd have bought 5 days earlier, the stock was a little higher, but they would have gotten the payout in December. So in January, they collected $269. In February, they collected $1.07. March, you can read, right? So after 6 months, they collected $12.20. So in just to break even, that $23 stock would have to go down to like 11.02 and they'd be even. Well, it never went to 11.02. I think the lowest it's ever traded is high 17s. Okay, it's been up almost 30. I don't know if it actually was 30. I have a chart in front of me. But it's traded between 18, maybe high 17s, up pretty close to 30 twice. It's had that channel. But it's not enough where you can just predict it. Next time it goes to 30, sell it and put an order in to buy back at 19. That's an improbable. There's not enough time history. Okay, not to say that it doesn't. So my point is, I received $61,000 in dividend payments by owning 5,000 shares. Every month I multiplied that payout times my 5,000 shares. So I've collected 61. Nice, right? So in 6 months, in a few days, I'm rounding it to 6 months. Oh, what is the stock price? Well, let's put in the stock price. I think I put in $21.98. That's what it closed when the day I'm doing this, Monday night on 6/17. Oh, I got a loser, right? Paid $116,100, and I could only sell it tomorrow if it stays at this price for $109,900, right? So I lost $6,200. So anybody that calls that a loser is out of their mind, because I just got $61,000 back on my 116. So my real number, okay, is $170,000, because I added these numbers and subtracted this number, right? So I had 116, I collected 61, and then I lost 62 in the capital gain. So my 116 is now worth 170, because if I sell it for $21.98, I get to keep all of that money. Plus, I probably was buying another Yieldmax fund with those dividends or reinvesting, which I'm not accounting for here, right? If I was reinvested, my share count would be much greater than the amount of shares I simply bought back then. So I calculated the net gain, right? I took the 61,000 and I subtracted the 62, and I said, okay, my net gain after 6 months is 47.22%. And I just doubled it. I could have put my calculator in here down to the exact day and days owned, and it would have given me pretty close to this number. So my annualized yield is 94%. Now that assumes that I'm going to lose another 20% in the next 6 months, and I'm going to get the exact same payment. So what if my payments go down a little bit, but the stock goes up? So, I mean, it can vary. But my whole point here, peoples, is to say you got a considerable investment. What if this person has 10 times this amount of money and it's a small amount? I still would say if I had an income of close to, what's the average workout? In 6 months, it's over 10,000 a month in dividend income. Maybe I want to hedge that, right? Because I don't want the stock to go to $10 and be a break even, right? So a lot is involved in that kind of stuff. So let's go through it. So the easiest, number one choice is to find an inverse ETF on the underlying, within the Yieldmax or outside of the Yieldmax. So let me give you an example. Today, there's only one inverse fund. Now remember, they've applied for one on Nvidia, one on Apple. I think there are 30 or 40 that they've applied to the SEC. And then what they do, that's typically a 90-day window. It's about the day they file, they give the desired symbol, and then they give a prospectus, which by now the SEC looks and says, oh, it's Yieldmax, it's a single ETF, it's bear, okay, we know what your prospectus is. And they talk if there's any issues back and forth. Then Yieldmax has the right, once it's approved, to launch it. But they don't always launch it when it's approved. Sometimes they set on it for a while and say, is that going to fly in the market right now? Well, I can tell you on Tesla, as much heat as they got about that NAV reducing and having the reverse split, which is the only fund that's done that so far. And if you ever see somebody bad-mouthing Yieldmax, it's usually because they invested in Tesla. You could have invested in Tesla a while back and still got a positive return, but most likely you suffered NAV reduction. It's just which price did you pay for it versus how much yield did you get, right? But it's not a positive regardless when your stock gets cut in half. But I can look at that chart, everybody's going to say it's hindsight, and see that that stock went up 20x from, early 2019 to 2021. So it was very prone to going down after a 20x run up. So the fact that it's gone down shouldn't be that much of a surprise. Just like if you think it may turn around, which I do, I don't know the timing, so I'm not in it yet, because I think Optimus, the robot with a 25 trillion, Elon Musk is brilliant. He's also optimistic. So what's the timing? What's the turnaround on the economy model and the S-curve associated with that? I don't mean turnaround. I mean, he's lowered down to 1% interest. He's done a lot of things to push the market. He's a brilliant guy. So he'll get that right, and that stock will once again soar. I can't tell you when it is, right? When I get a sense of that, I will be long Tesla again, right? I may even, on the side, do a 2x long Tesla, not inside the Yieldmax family. There's nothing wrong with owning the underlying and owning the income fund, right? They're two different objectives. One really moves when the stock moves. The other one pays you handsomely along the way. All right, so I was going to tell you that Tesla and Crash are an example of Yieldmax funds that both pay you a NAV price, and they both go up or down in NAV based on whether the underlying Tesla is going up or going down. So enough of that, but I just wanted you to, if there is one out there, go get it. So I looked around. I don't see a bear coin ETF. And what I mean by that is just some company comes out and says, hey, buy our $20 stock. It goes up based on how much coin goes down. And we call it a 1X, right? It replicates one-time performance in the opposite direction of Coinbase and coin. That would be a great ETF to have. If it's in Yieldmax, it's even better. Okay. So, but there is a 2X long. So I suspect there'll be, if you look at Conal, C-O-N-L, I think it's Granite shares, Granite ETF. But if I'm super bullish on coin at some time, and I go, man, Coney just can't keep up, coin's running, I can go take some monies and put it in Conal. But I'm not going to set in and write it, because even an up wave goes up and has a retracement before it gathers energy to go up again. So there's a lot of things involved in these, and we're talking about hedging. So I'm just trying to share. So let's assume for a minute there's not an inverse, is what they would call it, or bear ETF, because they're priced cheaper. If you go out, first of all, if you try and short coin, very difficult. You're going to pay interest to short it. Number two, it's a 1,400, what's the price on, or sorry, that's the Mr. It's a $240 stock. So you're talking a lot more expensive, right? The options are very expensive. I'll talk to you, and I'm going to show you put options, right? The very first thing that people think of about puts is, oh, that's a bear bet, right? I buy a put. That's correct. If you sell a put, that can be a bullish method, right? That you can buy the stock much cheaper just in case it drops. But normally buying a put is a protective, or you're betting that the stock's going to go down. So we'll talk about that. The problem is that the options are very expensive because the implied volatility, the IV, the 30-day IV, is very high on coin. So the final, before I move into these, you could do an inverse BTC ETF. Now, they're not one for one. There's been times that BTC was moving and coin didn't move. But I'll bet you there's a 70 to 85% correlation. Just go look at a stock chart. I probably should have made one for this, right? And you see the movement. They're going to mimic each other for a large part. So this, in my opinion, right now is probably the easiest and cheapest method. So let's jump into that. All right. So who has these? Now, there's multiple, I believe, companies that have inverse BTC as well as have long BTC. Yieldmax is long BTC via Ybit, but they haven't launched a bear fund. They could. Okay, so let's go to ProShares. And ProShares, I own this one. This is a BITO. It's kind of like Ybit. It's long 1 times BTC. Pays a nice dividend. So I went out here and I just showed you the dividend used to really be low, and it got pumped up, and here it is paying 177, 168, 115. I think I've collected since March, February or March. And then once Ybit came out, I bought a little bit of Ybit. So what you can do here, we don't want a bull fund, right? If we want protection, we want to make money when BTC is retracing, which is going to cause coin to retrace, right? They mimic and they correspond or correlate close enough that it's going to bring it down. You could have a day where Bitcoin was up 2% and coin was down a half, of course, right? But if you have a 20% move down in BTC, you're going to have a 15+% move down in coin. So, because although they're a marketplace and they're not a coin, they make their money off the popularity and all the activity associated with crypto and BTC, right? They're a marketplace, an exchange. So let's take a look here at a couple other methods, and then I'll show you some examples. And I got one kind of cool surprise on some of these that could work out. So if you look up online traditional hedging, related to the stock market, you're going to read something called a protective put and a married put. So let's go out and look at I'll just tell you, I don't. So what you're doing there, and again, the problem when I show you, I'm going to pull live stuff from today so you'll see how much it costs. I find it'd be like having $1 million house and you're having to pay, $90,000 a year in house insurance. That's pretty ugly. So that's the way these puts, right, for the protection, they have massive premiums. And there's some ways to skirt around that just by going out here and buying a fund like this. So BIDI is a 1x bearish BTC. In other words, when Bitcoin goes down, BIDI goes up. And so it's trading at $7.64 because Bitcoin's been a long time going up. It may trade sideways. And then they're 2 times the leverage, right? And these reset every day. So they're somewhat notational, but it may not correspond perfectly to a 2 times or a 1 time. And watch this, look at it, and sort of assess the practicality. But I can tell you it's much cheaper than buying puts. So you have these two. And remember, if you say, well, I've got 5,000 shares, how much protection do I want? Well, normally, if you just went out and bought a protective put, you would want 5,000 puts, so you divide that by 100, right? And that would tell you would want, because there's 100 shares in a put. And if you've got 5,000 shares, then what is that, 50? Yeah, that's 50 puts that you would want to buy to have a 1-for-1 ratio, but very expensive. And then this strategy of whether I do at the money, out of the money, or in the money, when I pull it up, I'll talk to you about that. I don't want to confuse you. The second option, less expensive, but sort of a cheaper put option, but a limiting put option. And I'll show you an example. Okay, let's take this. I can tell you, but sometimes it's out there. So I go to Investopedia. Let's say an investor purchased 100 shares of General Electric. All right, let's say an investor purchased 100 shares of Coney. $10, $20. It's important that we use the same dollar amount in here. So the price of the stock then increased to $20, giving the investor $10 per share in unrealized gains. Right? It's unrealized because it hasn't been sold. But it's a real profit. I always refer to them as paper profit. Yeah. So the investor does not want to sell GE because the stock might appreciate further. But they also don't want to lose the $10 in unrealized gains. So the investor can purchase a put option. Now, you could argue that I bought coin for $22. I don't want it to go down more than $1 or $2 or $3 because I know I'm getting a nice yield, but I don't want to have a big NAV reduction. I don't want to see this thing at $14 or $12 or $10. I might accept $2 or $3. I can make that up in 2 months of dividends. Okay? So the investor doesn't want to realize it, so he goes out and buys a put option. Now this is a low IV example. So he buys a put option with a strike of $15, right? If he buys it on 20 to protect all 10 of that profit, he's probably, even given this example, he's probably going to pay $2. But if he drops it down to 15, he's only protected at 15 and below. If it goes to 19, 18, 17, 16, 1501, they just keep the 75 cents he paid and he's done. He doesn't owe them anything and they don't owe him anything. Basically, they kept the premium. But he was protected, okay? So what creates a worst case scenario of selling the stock for 15? Put option expired in this case in 3 months. How about if the stock fell to $10? He's protected every penny below 15. So he's got a $5 value built in to that stock. So if the stock drops to 10 at expiration, he sells that put for $5. It has no more time premium, 75 cents gone. He collected $5 because it's $10 below 15. So he just got handed $5 for every single share he's got. And then he has to subtract the 75 he spent. So he made $4.25 on something that went down $10. But by lowering it to 15, he paid a small amount for it. Okay? So they're just going to take you through that example. I just told you because I fully understand it. All right. So that's an example. Let's go to real world coin, and I'll depress you. And then I'm going to show you something called Coney options. Now, only on some of the Yieldmax funds have they been trading long enough to have options for the exact fund. And I will say to you, the volume isn't big, and anytime you have low volume, as opposed to coin, which has huge volume, because that's what Yieldmax is using to mimic, and they can write thousands and thousands of contracts. Okay? So I want to give you an example and how expensive it would be, but it would be perfect insurance. But it's going to cut down on your yield, but it's going to protect you. So here's coin, and I made a static copy of this, so this holds true for Monday night at the close and until we get to pre-market, which is coming up. So this is looking at Coinbase, right? Coin, company name Coinbase Global. Closed at 245.10. So as I scroll down here, I put in 180 to 244. Why? I don't want to go and put a 245 put on. I'm going to pay through the roof. For me personally, if I chose this method, which I wouldn't, I probably would do something like a 200 or a 180, because that's the severe loss, right? 240 to 200, heck, it's been 200 2 or 3 different times in the last 2 months. So I don't, that's all within its trading range because it's a high IV. But if this thing breaks down and goes down to 120 and you bought it at 240 and you're getting nice premiums, you're devastated, right? But I'll give you this analogy. If you go out and bought a piece of real estate and you turned it into a rental house, and then the market, somebody on Zillow, somebody on another service, realtor walking by, and you said, hey, what's my house worth? They said, oh man, they're depressed right now. They're down about 35%. Do you run out and sell your rental? No, you let the market, right? You set on it. You rent, you keep collecting your rent. Well, that's also a good idea in Yieldmax, but make sure you understand whether you're really it's now become a bear cycle and it's going to continue down and stay down over the next couple of years, which in turn will reduce the yield. Because your stock, your NAV price is going down, so the percentage of the yield goes down. But just declining alone 20 or 25%, not going to kill you. So let's look at so what we have on the left, I marked up the one for Coney, but I didn't mark this one up. So I'll just, I know this stuff cold. So I got volume over here, open interest, volume, last, low, high, but we only care about the right side because we're looking at puts. See this little puts? This is the price of all the puts. This is the price of the calls. We don't care about the calls right now. We want to buy a put, which is we would call a protected put on coin, because it's 1,000% correlates to Coney, because that's what they're doing, is they're buying and selling calls and puts in a strategy. So when coin goes down, the coin puts go exactly up. So let's go out a little further, because one of the things that I need to teach you, the reason that Yieldmax to collect income sells weekly calls, when you move into a high yield, and it's true of any option, but when you have a high IV and thus a high yield on your options, every week has the highest yield. If you do that 52 times, if I go out 6 months, it's going to look high, but if you look at what the yield is every week, they're going to be substantially higher than just going out one time 6 months. So if you think you're going to hold this, especially if you're hedged now and just collect the yield, go out 6 months, go out 12 months, because even though it's a lot of money, it's per week much lower. Hopefully that resonates with you guys and you understand it. Okay, so this is an example. Look, 180 that's $64 underneath the current price. Who cares about going to a short-term option? I want to go further out, right, to save my money. And this is not, oh yeah, I can scroll it back over. Okay, here's my dates. So let me get my dates. And I figured the soonest I really even would consider is October. It's June, I don't care about July. And let's just look at October as an example. And then I'm going to go out and show you something further out. Although I can only go to January again because I took an image. But I can pull my real screen over and show you that, right? I copied and made an image. Oh, I take it back. I can go to January. All right. So let's look at an example of October. If I tried to protect to October 18th, which is what? July, August, September. So if I went 4 months out, right? And these are your major monthlies that expire on the third Friday of the month. So basically, if I went 4 months out and I want to protect this to within $240, anything below $240, it's gonna allow me to sell it for $240. If it drops to $120, I can sell it, I can sell the put for all the money above $120. It doesn't matter. Whatever the stock price is, I can sell it at $240 in October. But you know what I have to pay? I have to buy between the bid and ask. Since there's a lot of volume, it's probably like $36.80, right? Just split it. 60 cents, so you could easily go in there at this price at this time and buy a put for $36.80. That's a lot of money, right? It's not a lot of money if the stock goes to 160 or 150 or 140 or 130 or 120. So let's take a better example, though. You want to get it cheaper? You want to go out and buy a 180 strike. So you're going to pay, between $11.25 and $11.60. Let's use 20 cents. So I can buy it for $11.40, maybe $11.38, right? So you're gonna always try to offer something in between the bid and the ask. So I want to go out and buy one contract for each 100 shares that I own. If I own 5,000 shares, I think that's 50, right? The math works, because 10 times 100 is 1,000. Yeah, so it's 50 contracts. If I want to marry the put in all of my shares, I could choose a portion. So what do I get when I do this? What's the difference? Okay, well, I paid a lot less than 36. So if I bought 50 of those contracts, you got to multiply it by the math. It's a lot of money any way you look at it. But I don't start my protection until 180. So their market at 181, any price above 180, they just keep your premium. Whatever you paid, it just goes away. You lost when you buy house insurance, they don't come back at the end of the year and say, hey, there was no fire, so let me give you half of it back. That'd be nice, wouldn't it? But that's not the way it works. So when you buy a put, your only risk is the price that you paid for the put. And they either just keep it and it gave you no value, or they have to perform magic if the stock drops to 100. Stock drops to 100, then you're going to sell that put back to them for 80. You only paid 11 for it, and you're selling it back to them for 80. So you did very well. So that's how strike prices work with these options. So to me, but if you did this every 3 months, you're spending, or 4 months, I think we figured, June, July, August, yeah, it's every 4 months, you're paying $11. Well, let's just jump out to 18 months out. So you only have to pay 42. And now you're gaining, instead of 4 months, you're gaining 4.25 times. But if you multiply 11 something times 4.25, it's greater than this number. And so that's all I'm trying to say, is it drops a little as you go out. And you would put the 180 on here. Look how expensive the 70, you'd pay 75 for a 240. But you would sleep knowing that you're going to be getting a dividend, and no matter what the price goes to, you're going to be able to sell that, essentially sell the stock back for 240. You're really selling the option, but the option, all that value that you're collecting on the put is making up for the NAV reduction, right? So you're getting money back that you lost, but you're also collecting that income along the way. So hopefully you guys understand that. There's only so much you can do here in a press. So let me get through this. So as I mentioned, some of the Yieldmax funds that have been around longer, the Teslas, the NVIDIAs, I didn't check NVIDIA, but I'm sure it does. The actual options are on the fund, but look at their volume difference, right? Go back over, whoops, where do I have the other one? Oh, these are moving. Sorry, I'm not on the right screen to do this. If you look, yeah, it's not going to work right now. It doesn't seem like I can get back to where I was. All right, so you will notice, though, it's very thin volume. When you're looking at Coinbase, if you start looking at that, you will see thousands. I mean, when Yieldmax puts on, they may put on 17,000, 5,000, 1,500. You don't see that volume here. No institution is trading. This is all retail guys that own Coney that are simply going out and hedging. I can give you all kinds of strategies, but they do things beyond hedging. Let me give you an example, and I'll make it fast. Let's say you own coin at 20 and it's 22, and you're like, yeah, I like the dividend, but I'm thinking of another one. I don't really want to sell it, but man, if it gets to 25, I'd sell it, right? Well, here's a strategy besides doing that. Why don't you go out to January, if you're willing to wait. Well, I didn't even go that high. How about this? I go out to January 25, and I go over here. Now I got to go to calls, right? This is a different strategy. This isn't hedging. This is just saying I want to get rid of it. And if I want to sell a call, I can sell the call, doesn't look like at about 80 or 90 cents, right? Again, some of these are thin because they're not big. Most people are using it inside a short period, right? So not a great example, but I could collect 90 cents for, for per share, and then and this is at 23. And only if it's above 23 will they take the stock and pay me 23. Otherwise, I keep the 90 cents. because I was willing to sell it at almost at 22 now, so that's not a great premium, right? But let me show the example of what we really talked about of hedging. Okay, so we don't want to do anything close. Now the problem with these, not only do they not have a lot of volume, they also don't go out the multiple years like a Coinbase. They're going to have what they call leaps. They're going to have a January 26, a January 27. You know, they're going to go months and all that, but they're going to have multiple years because it's a massive option liquidity. But on these, they're new funds. But let's go pretend we're hedging. Okay, so we're out here in either October or January. Okay, so you tell me sort of, but I'm mentally going to do it. I'll give you my perspective. Okay. I'm saying, hey, I got in Coney at $20. I don't need to hedge it much more than 15, right? If it goes 19, 18, 17, 16, I've been collecting dividends for a long time. I'm still way ahead of the game at those prices. I'll probably just buy more. But if I'm a new buyer and I come in here and I buy it at 22 and I put 50,000 in it, and I'm nervous, right? I'm not sleeping at night. I always say you don't ever buy anything or use so much capital or use margin where you can't sleep. I've been there. I was doing futures on the gold market where, you know, I was making 250, 300,000 a year in my salary and my commission, but I was risking, you know, I would make 275, 250, lose 125 daily on futures. And it just got to be where I could hardly sleep. I just, you know, it was on a $2 million portfolio, so it's a little bit different, but still, you know, when you figure the amount of money, I said, I can't concentrate on work, you know, it's just too crazy. So I dialed back the leverage and lowered my amount of contracts, but it was a good lesson. All right, so let's get to this. So on a hedge, we can go to October 24. So we do our 4 months. Remember what we were talking about with them? We went from 240 all the way down to 180. Percentage-wise, let me do the math. 240 to 180, that's 60, that's 25% lower than what it's trading at. Okay? So if we took that same method and it's trading at 22, okay, so 10% is 2.2, 20% is 4.4, so let's call the other 5 1.1. So we need to go 5.5 down from 22. So we want to be around 17, maybe 16, okay? So what does that cost us? That cost us $1.30 to $2.15. And you notice the bigger spread? Well, you may not notice because it's thinly traded. So you're going to have to hang an order out there and see what you can get filled at, and don't give in, right? Don't go pay $2.15 to buy this put. Bid and ask, right? But just hang a 165, 170. The guy will maybe move this up to buy it at 170 to sell it at 170. They'll play games with you, but you know, you may not have that skill. But I can, you know, advise. But the point is, now that at least I can buy a put on Coney, it's on my fund price, right? It's it's 100% tied to Coney. So to me, that's an even better strategy. But don't depend on every fund out there in Yieldmax. The bigger, longer existing funds have these. I'm not sure I don't think Misty has option. I'll check, but I'm going to do that video later after I do this. So there's your method, right? For somebody who's putting all their money in, they say, well, Briss, I don't want it to go that low before. I want to do an 18. Well, then do an 18, right? So you're covered at anything below 18. 18 and below, you're covered with that put. What's your liability? It's the cost of the option. If you got 100 shares, it's going to cost you whatever you can buy between those prices. But if it's more shares, then you got to buy more contracts. It's simple, right? Or you say, well, I'm going to protect half of it. I mean, there's a lot of different strategies. And then my final one is sort of a bear spread or a put spread, and it's a little too complicated to get in and make this video lengthy, but I'm happy to do a separate video on just how to do that. But I'll wait and see if there's demand for that. That's a limited protection, and you use some of what you get by buying one put at one strike price and then selling another put at a different strike price, and your protection is just between a couple ranges, like between 16 and 18, or in this case it would be coin, right? And it allows you to be protected between two strike prices, and it's limited, but it's limited in the cost because you're getting a credit for the one you sold, and the one you bought is a little more expensive. Okay, guys, that's what I got. So hopefully that resonates. You start to get an idea. Don't get overwhelmed with it all, because again, options can be, but it's the idea that you want to protect large income flows. But again, most of it is just in the yield, right? Think of the rental housing scenario. You don't go dump the rental house because it went down 30%. Maybe rents didn't go down. And even if rents go down a little bit, maybe the house is paid. Think of the house is paid for, right? You got a real world example. It may be a mortgage. Here, you bought the stock. It's paid for. You can continue collecting dividend. It's just if the value erodes and erodes, that's a psychological drain, and more than 50% is not something I'm willing to allow to happen. If I get a 20% reduction, I'm gonna put some protected puts. I'm gonna buy an inverse fund. Like I said, there's many ways to do it. Okay, I'm gonna let you guys go. Again, I'm not a financial advisor. This is not financial advice. Okay, Bruce out. Peace. Bye.